Over the 24 hours spanning December 10th and 11, 2025, global markets moved through a pivotal moment in the post-pandemic financial cycle, where easier money, liquidity strains, and company-specific shocks all collided. The United States Central Bank sat at the center of this shift. It cut its main policy rate by 25 basis points to a range of 3.50% to 3.75%, its third cut in this easing cycle. While the move was fully expected, policymakers signaled caution. They do not want to promise a steady series of cuts in 2026 because inflation expectations remain sticky and the labor market is still resilient. Their latest projections show only one more cut in 2026, leaving the end 2026 policy rate higher than markets had been expecting. Some officials even wanted to hold rates steady out of concern that inflation, boosted in part by tariffs, could repeat the instability of the 1970s, while others argued the real policy rate remains too restrictive and risks over-tightening the labor market. More important than the rate move itself was a shift in how the central bank manages its balance sheet and market plumbing. Stress in the repurchase, or repo, market has been building, visible in rising overnight financing rates and heavier use of central bank liquidity facilities. With reserves in the banking system nearing their effective lower bound and the excess liquidity from the post-pandemic period essentially exhausted, the central bank announced it will resume buying Treasury bills starting December 12th, with an initial purchase size of $40 billion. By buying short-term bills in the secondary market, it injects fresh reserves into the banking system, easing the scarcity of cash, relieving pressure in overnight funding markets, and trying to ensure secured overnight rates do not trade persistently above the interest rate paid on reserves, a sign banks would be hoarding cash and interbank funding would be under stress. Usage patterns across its facilities underline that the issue is liquidity distribution, not broad bank solvency. The standing repo facility has seen record usage in the fourth quarter of 2025, indicating private markets alone cannot fully absorb the steady supply of government debt. The primary discount lending rate has been nudged down, but there is no evidence yet of a classic banking crisis. Meanwhile, balances in the overnight reverse repo facility have shrunk from trillions in 2022 to almost nothing, confirming that excess liquidity has been fully drained. This is why the new Treasury bill purchase program is so significant. It marks a return to balance sheet expansion with a targeted focus at the short end of the curve.
The immediate reaction in bond markets captured the clash between easing monetary policy and ongoing inflationary pressures from fiscal policy and tariffs. The yield curve underwent a bull steepening. Short-term yields fell more than long-term ones. Two-year yields dropped noticeably, reflecting both the rate cut and the presence of the central bank as a strong buyer at the front end. 10-year yields eased slightly off recent highs, more on relief that further hikes seem off the table than genuine confidence about long-term inflation. 30-year yields, however, remain stubbornly high, supported by a rising term premium tied to concerns about long-term debt sustainability and the inflationary effect of the universal tariff regime. Primary auctions reveal growing demand challenges for long-dated United States debt. A recent 10-year sale cleared at a somewhat higher yield than where it had been trading, implying dealers had to offer concessions to move the bonds. An upcoming reopening of the 30-year bond is likely to require a significant yield premium, with investors demanding more compensation to absorb the supply. The government is increasingly reliant on investment funds and foreign buyers, but foreign demand is not guaranteed. For example, as Japanese yields rise, the currency hedging cost for Japanese investors buying United States bonds goes up, which can undermine their appetite. A meaningful drop in metrics like bid-to-cover ratios at auctions would be a concrete sign of weakening demand for long-dated treasuries. Outside the United States, bond markets highlight an emerging divergence in global monetary policy. Japanese government bond yields are moving higher, with 10-year yields above 1.9% and strong demand even further out the curve. Markets are pricing in a rate hike by Japan's central bank, which would mark a significant turn away from the ultra-easy policies of the past decade. Rising Japanese yields act like a gravitational force, pulling global yields higher as capital is repatriated. By contrast, some smaller fiscally sound sovereigns such as Iceland have been able to cancel planned bond auctions because they are already fully funded, in sharp contrast to the large deficit United States. The euro area central bank is holding its main rate steady as it grapples more with stagnation than overheating. Inflation is near target, but growth is weak. Aggressive cuts risk weakening the currency and importing inflation, while hikes would deepen stagnation. Central banks in Switzerland, Canada, and Australia sit in different positions as well. Switzerland is holding rates at zero with low inflation to avoid an overly strong currency. Canada is on pause as it evaluates the knock-on effects of United States tariffs and sticky core inflation, and Australia is holding but with a bias toward further hikes, as its inflation remains above target, even as the United States moves into an easing phase. In short, the era of synchronized global policy is over. Equity markets over this period showed a system in transition. Broad United States indices rallied on the back of easier liquidity and the signal that rate hikes are off the table, but leadership within the market has begun to rotate. The large industrial index rose more than 1%, with investors moving into industrials and financials that benefit from a steeper yield curve and lower short-term rates. The broad market index approached record highs, but unlike earlier episodes driven by a handful of mega-cap technology stocks, this move was powered by broader participation. Small-cap indices even hit intraday records, as smaller, more leveraged companies with floating-rate debt are direct beneficiaries of falling short-term financing costs. At the same time, the technology sector, especially names tied to artificial intelligence, came under pressure after a high-profile earnings disappointment. A major enterprise software and cloud company that has been central to the AI infrastructure build-out reported slightly weaker than expected revenue but very strong headline profits, flattered by a one-time gain from selling a chip unit. Beneath the surface, the story was more complicated. Remaining performance obligations, a measure of contracted backlog, soared, and capital expenditures surged far above expectations. Investors concluded that massive infrastructure spending is racing ahead of monetization. Huge sums are being deployed to build AI-ready data centers and compute capacity, but the associated revenues are not yet flowing quickly enough. The stock dropped sharply, dragging down other AI-linked names, including prominent chip makers and conglomerates exposed to the theme. The episode signaled that markets are no longer willing to reward AI spending for its own sake. They now demand clearer near-term cash flows and profitability. Other equity sectors reacted differently. Domestic energy infrastructure companies have emerged as winners, benefiting from stronger power demand linked to data centers and from protectionist trade policies that hurt foreign competitors. Some niche technology and data firms posted outsized gains on strong earnings surprises, showing that the market will still pay a premium for distinct, credible growth stories. Defensive sectors like utilities also gained as falling bond yields made their relatively stable dividends look more attractive compared to government bonds. On the losing side, a number of defense and industrial companies failed to meet already elevated expectations and were punished accordingly. High valuations leave little room for disappointment. Certain manufacturers that cut dividends or missed earnings saw sharp sell-offs, reflecting how hard it is to pass on higher costs in a world of tariffs and persistent inflation. Semiconductor and infrastructure chip makers saw bouts of volatility, driven by rumors of large cloud customers shifting orders to custom chips, followed by rapid reversals as firms tried to calm the narrative, underlining how sensitive these names are to headlines. Options markets added another layer of complexity and acted as an early warning system for volatility. There was a spike in call option volume on a well-known video game retailer that had been at the center of prior retail trading manias. Large purchases of out-of-the-money calls suggest either renewed interest from retail traders or strategic attempts by more sophisticated players to engineer short-term squeezes via options dynamics. Meanwhile, in the large software and cloud company at the center of the AI debate, options flow ahead of earnings showed heavy demand for long-dated, deep out-of-the-money put options, clear evidence of institutional investors hedging against a sharp valuation reset. Short-dated bullish options held by more speculative traders were rendered worthless when the stock sold off after earnings. Overall, implied volatility indices rose even as stocks rallied, a combination that signals investors are buying equities but also paying up for downside protection, reflecting an underlying suspicion that the soft landing narrative is fragile. A key macro backdrop for all of this is the United States tariff regime introduced in April 2025. The policy imposed a universal tariff on imports, with especially high rates targeting selected key trading partners, though some supply chains enjoy exemptions. These tariffs are now central to both the inflation picture and sector-level performance. They are a main reason inflation has proven sticky, especially in certain consumer categories where prices have jumped by more than a third as importers pass on higher costs. The burden falls hardest on lower-income households, making the tariffs function like a regressive tax. Domestically, producers of metals and similar protected goods enjoy reduced foreign competition, enabling them to raise prices and supporting their stock performance. By contrast, import-heavy retailers, especially in electronics and apparel, face squeezed margins as they are caught between rising input costs and consumers who are reaching their limits on price increases, leading to underperformance in discretionary retail stocks. The legal fate of these tariffs now hangs with the Supreme Court. If the court were to strike them down, it would likely deliver a sharp disinflationary shock, forcing a major repricing across risk assets as inflation expectations reset lower and growth prospects change. If the tariffs are upheld, they will likely entrench a more stagflationary environment characterized by slower growth and higher prices, complicating life for central banks that are already trying to balance employment and inflation. Another complication is the recent United States government shutdown, which has delayed the release of key economic data. For example, the November Consumer Price Index report has been postponed, forcing markets and policymakers to rely on models, estimates, and anecdotal information rather than official figures. The central bank's rate cut came in the absence of fresh, hard inflation data, which increases market sensitivity to corporate earnings, surveys, and central bank communication as stand-ins for the missing numbers. This environment amplifies the importance of narratives and forward guidance. Global liquidity conditions are showing early signs of improvement. In the United States, broad money supply has returned to positive growth after a period of contraction, which supports the idea of a soft landing. The new Treasury bill purchase program will mechanically accelerate this money growth into early 2026. In China, recent data indicate that monetary stimulus is filtering through into the banking system, contributing to a modest global liquidity tailwind. Yet the cross-currents from tariffs, fiscal expansion, and divergent monetary policies keep the overall picture complex. Currency markets mirror these shifts. The United States dollar index has edged lower following the rate cut and the renewed balance sheet expansion, both of which are fundamentally negative for the currency. However, the dollar's decline is muted by persistent weakness in Europe and safe haven demand tied to uncertainty around tariffs and global growth. The Japanese yen is strengthening as the gap between United States and Japanese yields narrows, and as expectations of higher Japanese policy rates lead to the unwinding of long-standing short yen trades. When investors who borrowed cheaply in yen to buy higher-yielding foreign assets begin to close those positions, it can be deflationary for global financial conditions, as that cheap capital is withdrawn from international markets and brought home. Looking ahead over the coming week, several key dynamics stand out. The central bank's entry into the Treasury bill market should help compress volatility in short-term interest rates, keeping key secured overnight borrowing costs closer to the policy floor. This backstop reduces systemic funding risk and is supportive of risk assets in the near term, The shock from the large AI-focused software and cloud companies' earnings is likely to ripple through the technology sector, with investors taking a more critical look at firms with very high capital spending relative to current revenues. Capital may continue to rotate from software and cloud names heavily tied to AI narratives toward more tangible cash-generating sectors like energy, industrials, and smaller domestic companies that are more straightforward beneficiaries of lower interest rates and protectionist policies. At the same time, as the Japanese policy meeting approaches, bond market volatility is likely to rise. If Japanese investors sell foreign bonds and repatriate funds to take advantage of higher domestic yields, that could put upward pressure on long-term yields worldwide, offsetting some of the easing coming from the United States.
Within this environment, a few broad investment approaches line up with the themes currently in play. In fixed income, favoring short-dated United States government securities, such as two-year notes, allows investors to benefit from both relatively attractive yields and the support of a powerful, price-insensitive buyer in the central bank. These instruments offer some potential for price gains if front-end yields compress further. In equities, a sensible positioning is to shift toward domestic producers that are either shielded by or benefit directly from tariffs, such as metals and certain energy infrastructure firms, while underweighting import-dependent retailers that may see sustained margin pressure. In the realm of currencies and international equities, positioning for a stronger yen relative to the dollar or using hedged Japanese equity vehicles can allow investors to participate in any domestic recovery in Japan without being overly exposed to currency swings. For more speculative traders, unusual options activity in names with a history of retail-driven rallies may offer asymmetric payoff profiles, but with a high degree of risk. Stepping back, financial markets appear to have entered a regime of what might be called managed instability. The United States Central Bank has pivoted not just on rates, but on the underlying plumbing of the system, stepping in as a structural provider of liquidity in short-term funding markets, and in effect, placing a floor under asset prices tied to systemic funding stress. At the same time, the ceiling on valuations is being lowered by the realization that large-scale AI investments will not produce instant profits, by the real costs of a persistent tariff regime, and by the gravitational pull of rising yields in countries like Japan. Investors trying to navigate this environment need to align themselves with the support offered by abundant short-term liquidity, while avoiding sectors caught between rising trade costs, high valuations, and slowing growth. The next key binary events, the delayed inflation report in the United States and the upcoming Japanese policy decision, will determine whether the current rally can extend or whether rising global yields and policy divergence ultimately overwhelm the liquidity boost and force a broader repricing across risk assets.